All right, now we are going to discuss measurements subsequent to the initial recognition, and this is known as the subsequent measurement. Like we discussed the initial measurement, and we studied that initial measurement should be at cost, and the cost was the cost of purchase plus any directly attributable cost to bring the asset in the working condition. We have discussed that thing in quite detail. And now we are discussing the subsequent measurement. This is measurement subsequent to the initial recognition, known as the subsequent measurement. So if we are keeping the asset at cost throughout its useful life, then that is going to be the misapplication of the prudence concept, because we know that prudence concept says that asset should not be overstated. We know, generally speaking, that whenever we are using the asset, it loses its value, and that concept is known as the depreciation. That we allocate the cost over its useful life. The concept is that whenever we are using the asset, it depreciates over the time. And if we are not charging the depreciation, then that means we are overstating the asset according to the prudence concept, and that is something not allowed in the financial reporting. So we have two models defined by the IAS 16 for the subsequent measurement. Now you can choose from either. You have the cost model and the revaluation model. And when the standard says that you can choose between these two types of model, that is your accounting policy. Now, it's not an accounting estimate. It is different from the one which we have studied in the depreciation. When we were choosing between the depreciation method, the depreciation policy, the straight line method, and the reducing balance method, I told you that is the accounting estimate. And I told you to explain you the reason why that is an accounting estimate. But here, when we are choosing between two models, this is your accounting policy. This is known as the accounting policy. Now, accounting policy are the rules, principles according to which we perform our accounting. So initially we measured the property, plant, and equipment at cost, and now we are having the subsequent measurement. And for the subsequent measurement, we have two models: the cost model and the revaluation model. So in the cost model, asset is going to be recorded at cost less its accumulated depreciation, less its accumulated impairment. And in the revaluation model, we are going to revalue these assets on a regular basis. When we say regular basis, that doesn't mean in IAS 16 every year. It is not compulsory that you're going to revalue the assets every year within IAS 16. I'm particularly talking about the IAS 16. So that says the sufficient regularity. We are going to discuss that in the next slide. So in the revaluation model, we take the asset to its revalued amount, which is actually the fair value of the asset in the market. And then we discuss the subsequent depreciation and the impairment. So how we will be deciding whether we are going to keep our asset in the subsequent measurement at cost model or the revaluation model. Now, again, it depends on the nature of the asset. For example, you are having an asset that will be used the same throughout its useful life, and there is not going to be any appreciation in it, that the value is not going to change in the market. When I say value is not going to change in the market, I mean the significant movement in the value of that asset. For example, you talk about the machinery. You know, you have purchased the machinery. You'll be using it for 5 years. And every year when you're using it, it is actually depreciating. It's losing its value. So when you have such type of assets, for example, you talk about the laptops. When you're using it, its battery timing is reducing, its speed is reducing, the quality of the screen is reducing. We know that these computers, LEDs, even the smartphones we are using, that depreciates over the time, and there is no appreciation in it. Like when we talk about the appreciation, that means the significant appreciation. For example, you bought a LED and you're using it for 2 years. You have used it for 2 years. Now, when you're selling in the market, obviously it is going to be lesser than its original value, much lesser than its original value, because you've used it for 2 years. So when you have the asset which is being depreciated, which loses value upon use, then we usually choose the cost model for those things. For example, we talk about the machinery, plant and machinery. We usually use the cost model for those things. And then we have the revaluation model for such type of assets which changes its value frequently And in a larger proportion, for example, you talk about the land. For example, I bought a piece of land in 2012 for 1 million. And in 2014, when I'm going to measure it, it is at 1.5 million. Now there's a significant increase in the value of land. So when we have such type of assets, which changes its value frequently and in a larger proportion, in a larger sum, then for those type of assets, such as land, such as building, we choose the revaluation models. Now it's upon you, it's upon the nature of the asset. But whenever you are talking about the accounting policy, make sure there is a consistency in the application of the accounting policy. Like, for example, you cannot choose it this way. Like, for example, in the year one, you are choosing the cost model, and next year you're going to use the revaluation model, then coming back to the cost model. Now, this is not allowed by the standard, although accounting policy can be changed as well. Accounting policy can be changed as well. There's a criteria for that. We are going to study that thing in IAS 8. But you just need to remember that whenever you have the accounting policy, there should be a consistency in the application of the accounting policies. So for the subsequent measurement, we have two models, the cost model and the revaluation model. In the cost model, we are going to take the cost of the asset, deduct the accumulated depreciation. Now we have already discussed it. That accumulated depreciation is a depreciation we are accumulating, and the accumulated depreciation is being used for the calculation of the carrying value. When we have accumulated depreciation at any point in time, we are able to calculate the carrying value. And then we have the impairment loss. Now, although there is a separate standard for understanding the impairment, which is IAS 36, but here I'm going to give you a flavor of what is impairment in order to understand why we are deducting it from the cost of the asset. Now, there's a common thing between the depreciation and the impairment. And that common thing is that both the depreciation and the impairment is actually a reduction in the value of the asset. Because you see, we are deducting the depreciation, we are deducting the impairment from the cost of assets. The common thing is, but that both the depreciation and the impairment is actually a reduction in the value of the asset. But the depreciation is always systematic, and we have studied the definition of the depreciation. That is the allocation of the cost over its useful life. So is the systematic allocation of the depreciable amount over its useful life. We bought an asset for 100,000. Let's assume $100,000, and the useful life is 10 years. So we know that the per annum depreciation is going to be 10,000. So after the first year, at the end of the first year, by the end of the first year, the carrying value of asset is going to be 90,000. By the end of the second year, the carrying value of the asset is going to be 80,000, and so on. This is the systematic allocation of the depreciable amount over its useful life. Every year you are charging 10,000 as an expense, and you're deducting it from the cost of the asset. So it's decreasing the value of the asset. And then you have the impairment. Now, impairment is not systematic and depends on the indicators. Like, for example, you're talking about this asset. You bought it, let's assume it's a machinery. It's a machinery which you bought for $100,000. And you estimated that you're going to use it for 10 years, and the depreciation is 10,000 per annum. By the end of the first year, it is recorded at the carrying value of 90,000. By the end of the second year, it is recorded at 80,000. Now, something happened by the end of the second year, and your machinery got damaged. Like, for example, due to any event, for example, due to flood, or for example, due to electricity breakdown, due to high electricity, high voltage, your machinery has been damaged. And when you are selling it in the market, the damaged machinery, when you are selling it in the market, it is being sold at $40,000. Now, for example, if you keep this machinery at the carrying value 80,000 instead of $40,000, although it can be used, but the market value now is $40,000. And if you're keeping it still at the carrying amount, then the asset is going to be overstated. Now, this reduction in the value from 80,000 to the 40,000 is known as the impairment. And impairment is not systematic. How this resulted? This was due to the high voltage and the machinery got damaged. There may be any other reasons as well. For example, now this machinery which you're using, now the government has made the regulation that this machinery is not allowed further because it has more carbon dioxide emissions, and you need to use the environmental eco-friendly assets. Now, when you're selling this machinery in the market, no one is buying, and even if someone is buying, they're buying it at the scrap value. Now, that means this machinery has suffered an impairment. Similarly, there may be other reasons as, for example, the market value of this new machinery is now $70,000. Now, if you're keeping it at $80,000 by the end of the second year, you're overstating it. So remember that depreciation and the impairment both are the reduction in the value of the asset, but the depreciation is systematic. And impairment depends on the indicators. For example, asset got damaged, it got obsolete. The government has changed the regulation, and now you cannot use it further. For example, the market value of that asset has changed, and many other indicators as well. So due to those indicators, if the asset is suffering, that is known as the impairment. So we are going to deduct both the depreciation and impairment from the asset, and that will give you the carrying value. And hopefully you have understood the concept of the impairment, and you will get more details in IAS 36. So this is the cost model. Cost minus is accumulated depreciation minus accumulated impairment loss. And then we have the revaluation model. And I told you that in the revaluation model, we have the assets. We are going to keep the assets whose value is volatile. That means it is going, whose market value and the fair value is going to change frequently, regularly. And that change is going to be a substantial change. So we are going to keep those assets at the revaluation model. For example, we talk about the land. I purchase a piece of land for $1 million. And after 1 year, its fair value has reached to 1.5 million. Now it's a big change in the market value. And if I keep on recording this land at 1 million, then it's not the fair presentation. Similarly, let's assume by the end of the second year, this land has reached to 2.5 million due to the increase in the market prices, due to the high demand in the piece of land. Now, if I keep it in the cost model, I will be keeping it at 1 million and the market value is 2.5 million. I'm understating the assets. So that means when you have the certain assets which are changing their value frequently in the market, and that change is substantial, then you are going to keep those assets on the revaluation model so that you got the fair presentation. We are just doing it for the fair presentation, nothing else. So the revaluation model, in the revaluation model, we are going to take the revaluation. The revaluation model means this is the revalued amounts. And then we are going to deduct the subsequent depreciation. Now, this is something, again, a very important concept, why we are calling it as the subsequent depreciation. Now, remember this point. And you have studied this in your earlier accounting as well, but if you forgot that point, no problem, I'm going to revise it. Now, why we are calling it a subsequent depreciation? We're calling it a subsequent depreciation because whenever we do the revaluation, the previous depreciation is de-recognized. Remember this thing. And obviously, we are talking about the depreciating assets. If it comes to land, we know that land is not depreciated, so there will be no depreciation and the accumulated depreciation of the land. We are talking about the other assets, for example, plant and machinery, building, lease property, things like that. So whenever you are going to do the revaluation, the previous depreciation is de-recognized. Now, we have studied that the double entry for recording the depreciation is debit, depreciation, credit, accumulated depreciation. So the nature of the accumulated depreciation is credit. So when we are revaluing the asset, the debit goes to the asset, and we are going to de-recognize the previous depreciation, debit, accumulated depreciation, because the nature of the accumulated depreciation is credit. In order to de-recognize it, you're going to debit it. and credit revaluation surplus, revaluation reserve, or other comprehensive income. And we are going to define this credit entry as well in the next slide. Now, the question is why we are de-recognizing the previous depreciation. So the answer to this question is that we are de-recognizing the previous depreciation because upon revaluation, once we have done the revaluation, the depreciation is going to be charged on the revalued amount and remaining useful life. So upon revaluation, depreciation is charged on revalued amounts and remaining useful life. That is why we are de-recognizing the previous depreciation, because the new depreciation is going to be based on the revalued amounts. So these are the two models, the cost model and the revaluation model. So you need to understand both of them in order to solve the exam question. So now we have the revaluation model, and we have already studied that we are going to keep the assets in the revaluation model whose value is market value and the fair value is volatile. That means it's going to change frequently on the regular basis. Now, in the IAS 16, there is no compulsion to revalue the asset every year. Instead, what the IAS 16 suggests, that the revaluation must subsequently be made. Once you have classified an asset in the revaluation model, the revaluation must subsequently be made with sufficient regularity. And it is not saying every year, it is saying sufficient regularity to ensure that carrying amount does not differ materially from the fair value at each reporting date. Now, the question is when we are going to revalue the asset. Every year? No, it's not a compulsion. Now, then when we are going to revalue the asset. So when you see that the carrying value and the fair value is materially different from each other, that means the fair value has grown in a larger proportion than the carrying value, then you are going to do the revaluation. It's not compulsory to do it every year. So you just need to compare your carrying value with the fair value. And if you see the fair value is much more than or much lesser than, there can be both cases, up and down, then you are going to revalue your assets. It can be, for example, after 2 years, after 3 years, every 5 years, whatever is the case. When an item of the property, plant, and equipment is revalued, this is again a very important point, and it can be tested in the multiple choice question or the objective test question as well. When an item of the property, plant, and equipment is revalued, the entire class of asset to which it belongs must be revalued. And this is to ensure no cherry picking. You're not going to do the cherry picking. Cherry picking means you're not going to select the selective assets which are grown in the value and ignore the ones which have decreased in the value. So the standard says, for example, if you are valuing the land, you're going to value the entire land which are on the revaluation model. If you're revaluing the building, you're going to revalue entire buildings which are on the revaluation model. If you're valuing the cards, you're going to revalue entire cards which are on the revaluation model. And we are not talking about the assets which are on the cost model. We are talking about the assets on the revaluation model. So the point is, for exam, the exam focus point is, this is something very important and you must stay attentive. The exam focus point is that whenever you are conducting the revaluation, whenever you are doing the revaluation, or whenever the examiner is suggesting you to do the revaluation in the exam question, you must calculate the carrying value on revaluation date. The carrying value, the carrying amount on the revaluation date must be calculated. And then it is being compared with the revalued amounts. And the revalued amounts means the fair value. Revalued amount means the fair value. So the carrying value on the revaluation date compared with the revalued amount, and the difference is going to be the revaluation gain / loss. So the double entry is going to be debit asset, debits accumulated depreciation, and credit other comprehensive income and the revaluation surplus. Now, this credit entry need to be understood. We already discussed the statement of changes in equity. Hopefully you remember that statement of changes in equity, in which I told you there is a share capital. We have the share capital. We have the share premium. Now, these share capital and share premium are the things which are being on the issuance of the shares. When we issue the shares, the value up to the par value goes in the share capital, and more than the par value goes in the share premium. We have already discussed that in the initial lecture. So share capital and the share premium. Then we have the retained earnings. These retained earnings are known as the accumulated profits. Retained earnings means the accumulated profits. And then we have this revaluation surplus. Now, when I say, for example, I have a piece of land and I bought the piece of land for $1 million. And right after 1 month, it is for 1.5 million in the market. And I'm going to reevaluate for now. When I'm going to reevaluate, debit land, credit revaluation surplus. Now, if I ask you, has anyone paid me this 0.5 million? Is this the cash inflow? No, it's not the cash inflow. It's just the movement of that asset within the books. So that is why we call these gains as the unrealized gains, because someone has not given us the cash when we have revalued the asset. It's just a movement in the books. And these unrealized gains will be realized, generally speaking, when the asset will be sold. For example, now if I'm selling my land at 1.5 million, then this 0.5 million will be realized. Otherwise, if I'm not selling the land, it remains the unrealized gain. That is why we do not record these gains in the retained earnings. This is something very important to understand. And instead, we keep a special separate reserve for that, which is known as the revaluation surplus. So in the statement of changes in equity, we have the revaluation surplus, which is a separate reserve for the assets which are being revalued. And this other comprehensive income, we know we have the statement of profit or loss and other comprehensive income. And this other comprehensive income portion, this OCI portion, is actually after the profit for the year. After the profit for the year, we have this other comprehensive income portion. I have explained that thing when we were discussing the lecture 2, introduction to the financial statements. So in the other comprehensive income, we will have the revaluation gain or loss. In the other comprehensive income, we will be having the revaluation gain or the loss. So let me just write it as the revaluation gain or the loss. And these are the unrealized gain, and generally speaking, these will be realized when the assets are being sold. Otherwise, it remains in the revaluation surplus, which is a separate reserve for that. Now we have the recognizing revaluation gains and losses. Now we have already studied the accounting for the gains, and I've told you the double entry. If it is a non-depreciating asset, for example, the land, if it's non-depreciating asset, let's assume the land, and there's a gain in that, then debit goes to the asset, for example, the land, and credit goes to the revaluation surplus. And if it is a depreciating asset, then debit asset, debit its accumulated depreciation, and credit revaluation surplus. So we are going to debit the asset, we are going to de-recognize this accumulated depreciation, and credit goes to the revaluation surplus. And then we have the revaluation losses. Now, in order to understand revaluation loss, there are two things you need to understand. Revaluation losses. Now, whenever you are charging a revaluation loss, be attentive. This point is very important. Whenever you are charging a revaluation loss, you need to see whether this asset was previously revalued. Whether this asset was previously revalued, the asset which has suffered an impairment loss. See whether in the past years, this asset was previously revalued and the gain recorded in the revaluation surplus. Whenever you have the revaluation loss pertaining to an asset, you first of all need to see whether the same asset was previously revalued and there's a gain in the revaluation surplus. If that is the case, then first of all, you need to de-recognize the revaluation surplus. And if there is any other, if there's still revaluation loss remaining, for example, the revaluation loss was for 100 and the revaluation surplus was for 80. So first of all, you'll be de-recognizing the 80. If still any revaluation loss remains, that goes to the profit or loss and credit goes to the asset. So whenever you are charging a revaluation loss, this is something very important because examiner tests this concept in the exam question. Whenever you are charging a revaluation loss, you need to see whether this asset was previously revalued and there's a revaluation surplus present pertaining to that asset. First of all, you need to de-recognize that revaluation surplus. If still there is any impairment, then you need to charge it to the profit or loss and credit goes to the asset. And if this asset was previously not revalued, then this revaluation loss represents an impairment. So the double entry is going to be straight away debit profit or loss, credit asset, because there is no revaluation surplus pertaining to this asset. So directly you're going to charge this revaluation loss or impairment to the profit or loss and credit goes to the asset. Now we have an example. A company revalues its buildings and decides to incorporate the revaluation into its financial statements. Company revalues its building and decides to incorporate the revaluation into its financial statement. And I've already told you that whenever you have the revaluation, you need to make sure that you are calculating the carrying value of that asset on revaluation date. So extract from the statement of financial position at 31st December. Okay, then we have the building. The cost of the building is 1,200. We have the depreciation, which is the accumulated depreciation, 144. And the carrying value of the asset is 1056. The building is revalued at 1st January 20x8 at 1400. So assuming in the 000. Its useful life is 40 years at that date. Show the relevant extracts. Now we have the figure on 31st December and they are going to revalue it at 1st January. That means exactly the same day, because it's a 1 day difference and we do not account 1 day difference. So exactly at the start of the year, they are revaluing the asset. So we take the carrying value on revaluation date, which remains the same. We do not charge depreciation for 1 year. So carrying value is actually 1056. And then it is being compared with the revalued amount, which is 1400. So what we are going to do is simply using the calculator, 1400 minus 1056, and it gives you 344. This is the revaluation gain. Now I'm going to write the double entry, which is something very important because many students does this mistake while writing the double entry. So how much is the revaluation surplus? Credit revaluation surplus or other comprehensive income by 344. And we have studied whenever we are doing the revaluation, the previous depreciation will be de-recognized. How much is that? 144. So debit accumulated depreciation by 144. And now the mistake student usually does is that they debit the asset by 344, which is the wrong treatment. You see the double entry, the balancing figure of the asset is going to be 200. Now, what is this concept? Remember that in the ledger, asset is recorded at cost. So we are taking the asset from 1200 to 1400. So the movement is for 200. And in order to ensure that you are not making any mistake, you can do it by calculating the asset as a balancing figures. You see the credit entry of the revaluation surplus by 344. Debit entry is 144. So the difference of 344 minus 144 on the debit side is going to be 200. How we can explain this 200? That in the ledger asset is recorded at cost. This is the concept which you have studied in your earlier accounting paper. So cost is for 1200 and we are taking it to 1400. So the movement from 1200 to 1400 represents 200. So this is how we are going to record it. And then when you talk about the depreciation for the further year, because they are asking you regarding the carrying value at 31st December 20x8. Now the new depreciation we have studied, the new depreciation is going to be charged on the revalued amount, which is 1400, and the remaining useful life, which is 40. So 1400 divided by 40 is going to give you 35. And the carrying value at 31st December 20x8 is going to be 1365. This is the figure that is going to be charged in the statement of financial position, recorded as an asset. This is the figure that is going to be recorded in the statement of profit or loss as the depreciation charge. This is the figure that is going to be recorded both in the revaluation surplus as well as the other comprehensive income. So you see on the next page, we have the extracts. So in the statement of profit or loss, we have 35, which is the depreciation charge. In the other comprehensive income, we have 344, the gain. In the non-current asset, we have the carrying value, which is 1365. In the statement of changes in equity, even in the statement of financial position, the same extracts, we have 344. And how this is calculated as 1365. This is how we have calculated the carrying value. And now we have the depreciation of the revalued asset. So whenever we have the revalued asset, we know that the depreciation is going to be charged on the revalued amount and remaining useful life. So it says depreciation is charged on revalued amount and remaining useful life. The concept remains the same. But in this slide, we have another concept, which is again very important, and I need your attention for that. In the previous example, we have the revaluation surplus of 344. Did you see this? We have this revaluation surplus of 344, and I'm explained to you that these are not the realized gains. These are the unrealized gains that will be present in the revaluation surplus unless and until this asset has been sold. This asset is being sold. So this remains in a separate reserve, which is known as the revaluation surplus. And the moment this asset is being sold, all of the revaluation surplus, let me just write it. When this asset is being sold, all of the revaluation surplus will be transferred to retained earnings. That means the gains will be realized. The double entry is going to be debit revaluation surplus. So we are de-recognizing it from the revaluation surplus, and we are crediting that thing in the retained earnings. Revaluation surplus has a credit nature. So when you are reducing it, it is going to be debit. Retained earning has a credit nature. So when you are crediting it, it is increasing. So basically what you are doing in the statement of changes in equity, let me just show you where I've explained you the statement of changes in equity. So when we are transferring the revaluation surplus from retained earning, there will be a movement, the movement from here to there. In the revaluation surplus, we are going to deduct it. And let me just show you how we are going to do it. We are going to deduct it from the revaluation surplus, and we are going to record it in the retained earnings. This is the movement we're going to show in the statement of changes in equity. This is the first principle, that whenever the asset will be sold, the revaluation surplus will be realized. That means it will become realized gain from the unrealized gain. But there's another method of realizing these gains. And what is that? Now, with this concept that when you are selling the asset, you are realizing all the gain from revaluation surplus to retained earnings, there's a problem. There is a problem. There's an accounting issue. The accounting issue with this is that in the year where you are selling it, all the gain will be realized. That means it will be shown in the, it will be added to the retained earnings. And when it is added to the retained earnings, there will be a movement, a substantial movement in that year retained earning. And maybe the shareholder see it as an unusual movement, and the financial statement becomes uncomparable with the previous year. Like how in this year there is a huge movement in the retained earnings. So that movement can be seen as the unusual movement. Now, in order to avoid that situation, some companies, in fact, many companies have the policy of realizing these gains systematically. Now, what they do usually, they take the gains and they spread it over the remaining useful life of the asset. For example, we have the gain of 344 and the remaining useful life is 40 years. So systematically every year, a portion will be deducted from the revaluation surplus, and this will be transferred to the retained earnings instead of transferring the immediate gain from the revaluation surplus to the retained earning. What we do systematically, we transfer it from the revaluation surplus to retained earning. In this way, the financial statements remains comparable. In this way, there's no unusual movement within the retained earnings, and the concept remains the same, that when we are using the asset for the entire life, the gain should be spread over the entire life as well. So this is the concept of transferring the revaluation surplus to the retained earnings. So there are two ways to transfer it, either on the disposal, and that is going to be an immediate transfer from the revaluation surplus to the retained earnings. And then we have the other option of doing it on a regular basis by spreading the gain over the remaining useful life. And every year the revaluation surplus will be debited and it will be transferred to the retained earnings. Now we have the concept of the disposal of the non-current asset. Disposal of the non-current asset. We are going to record the disposal of the non-current asset when the control is transferred. When the control is transferred to the buyer. When the control is transferred to the buyer. Now, control means all the risk and rewards are being transferred to the buyer, and there is no managerial involvement. Let me give you an example. For example, I have a car. Let's assume the worth of the car is, let's assume $5,000. Let's assume I have a car. The worth of the car is $5,000. I sold you my car for $5,000. And I told you that I will be buying this car from you within 3 years' time. Buying it back within 3 years' time. And whenever I will be buying it back within the 3 years' time, I will be giving you $6,000. I'm selling you my car. I'm taking $5,000 from you, and I'm stopping you to sell it to anyone else, because I will be buying it again from you from $6,000, buying it from you within 3 years' time for $6,000. So that means I'm not transferring the control of the car to you because I still have the managerial involvement in that. This cannot be recorded as the disposal. This type of arrangement is actually in substance a loan arrangement. What I'm doing, I am securing my car to you. I'm giving my car to you as a security and taking the loan from you of $5,000 and will be giving it back to you for $6,000. And the difference between these two is actually the interest, which should be recorded as a finance cost. This is a loan arrangement. And in that case, you cannot de-recognize your asset. You cannot record the disposal because the control is not transferred. So in order to record the disposal, there is a condition that when the control is transferred to the buyer and there is no managerial involvement. One more point. One more point is that the proceeds of the disposal, proceed of the disposal of non-current asset, proceeds of the disposal of non-current asset is not recorded as revenue. This is something very important to understand as well. When we sell the asset and we get the proceeds, which is the cash, this is not the revenue, because the revenue is the income from the ordinary activity of the business. Whenever we are selling the inventory in the ordinary activity of the business, that is known as the revenue. So don't ever record the proceeds of the disposal of the non-current asset in the revenue. If in the exam question they have done so, then you need to remove it from the revenue. So the disposal of the non-current asset, whenever you are disposing your non-current asset, you are going to make a disposal account. And I have mentioned the accounting entries of the disposal, and that is quite easy to understand. So when we are selling the asset, asset will be credited and the disposal account will be debit. So disposal account is being debit due to the asset. Then we de-recognize the depreciation because the asset is being sold, and credit disposal. So disposal account is being credited due to the accumulated depreciation. Then we record the cash proceeds or the receivable. So cash debit and disposal account credit. So disposal account is being credited due to the cash or proceeds. Now, if the balancing figure is coming on the debit side, that represents gain. And if the balancing figure is coming on the credit side, that represents the loss on disposal. But there's no requirement to make a disposal account in order to calculate the disposal gain or loss. You just need to compare the carrying value at disposal date with the proceeds. That's it. Calculate the carrying value at disposal date and compare it with the proceeds. If the proceeds are more than the carrying value, obviously it does make sense. If the proceeds are more than the carrying value, then it's a gain. And if it is less than the carrying value, then it represents a loss. That's it. So the double entry to record the gain is actually simply this gain which is being recorded in the disposal account. The double entry is debit disposal account, credit profit or loss. The double entry to record the loss is debit profit or loss, credit disposal account. So remember this thing. Disposal is only recorded when the control is transferred. Proceeds should not be made part of the revenue because it is not the revenue. And you are going to calculate the carrying value at disposal date, compare it with the proceeds, and then you are going to get the gain or loss on the disposal. When you have the disposal of the revalued asset, we know all of the revaluation surplus will be de-recognized and it is going to be recorded, transferred to the retained earnings. Now we have the major inspection or overhaul cost, which we have already discussed when we were dealing with the subsequent expenditure, that if you have done an expenditure on the major inspection or the overhaul, you are not going to expense that out on the immediate basis. Instead, you are going to capitalize it, and that will be depreciated over the overhauling period. So capitalize it and depreciate it over the overhauling period. We have an example to deal with this concept. An entity purchases an aircraft that has an expected useful life of 20 years with no residual value. The aircraft requires substantial overhaul at the end of the year 5, year 10, and 15. That means after every 5 years. So whatever the cost of the overhauling is, it should be capitalized and then depreciated over the overhauling period, which is the 5 years. The aircraft costs 25 million, and 5 million of this figure, that means within this figure, 5 million, is estimated to be attributable to the economic benefits that are restored by the overhauls. So that means when you see the cost of the aircraft is 20 million. And the other 5 million is the cost of the overhauling for the first 5 years, year 1 to 5, which is 5 million. In the year 6, the cost of the overhaul is 6 million, which is from year 6 to 10. The requirement is calculate the annual depreciation charge for year 1 to 5 and year 6 to 10. So that's simple. So when we have the depreciation for year 1 to 5, we need to depreciate, first of all, the asset. So 20 million divide by 20 years, because the life of the asset is 20 years, it is going to give you 1 million per annum. Then we have the overhauling cost, which is 5 million. Divide by 5 years. Again, it is going to give you 1 million. So the total depreciation charge per annum for year 1 to 5 is $2. Then we have year 6 to 10, and the cost of the asset remains same, $20 divided by 20, $1 per annum. And the overhauling cost for the next 5 years is $6, divide by 5 years, and it is going to give you 1.2. So the depreciation per annum for the next 5 years is 2.2 per annum. The last thing you need to understand regarding every standards are the disclosures. Although these are not important when it comes to the FR exam, you just need to give it a read. And this is all about IAS 16, property, plant, and equipment, which is a very important standard tested in the objective test questions as well as the final account question, in which you are required to prepare the financial statements and the financial statement extracts.